Welcome to the Retirement Income Show. I'm Mark Elliott alongside the CEO and founder of Oak Harvest Financial Group, Troy Sharpe. Troy's also a certified financial planner professional, but he's created a great team here to help you come up with your plan, your strategy for retirement. The Retirement Success Plan is all about whomever Troy and the team are sitting down with, getting ready for retirement or already retired. Income, investment, taxes, it just keeps going. Healthcare, estate planning, it's all part of the Retirement Success Plan. The idea is that Troy and the team are here to help. They just don't know if they can help you, though, until you reach out. There are ways to do that, certainly. The number, if you want to give them a call, it's 800-822-6434. No cost to chat with the team. 800-822-6434. We'll give you that number throughout the program. And you can always go to the website to find out more, oakharvestfinancialgroup.com. Great information there for you, but also you can find out more about Troy and the team as well, oakharvestfinancialgroup.com. And, of course, the office located right off I-10 in Bunker Hill at 920 Memorial City Way. And then, of course, there is the infamous YouTube channel, Troy Sharpe, Oak Harvest, over 300 videos on there. Great place to find out more about some of the questions and concerns you may have about your upcoming retirement, or you're retired and you're like, wow, this isn't really going the way I thought it would. Troy's probably done a video on it. Just search Troy Sharpe, Oak Harvest on YouTube. Troy, welcome to the show, and today Grace Gosnell is with us. You've got a special guest. Tell us about it.
Yeah, so we don't probably have enough guests on the show, but I had a chance to meet Grace almost a month ago, I guess. We had a chance to kind of get down and formulate either a video for the YouTube shoot, and then I was like, this is such a great concept and something the listeners probably really would like to hear about. So I invited her to come on the radio show. So Grace is from Scoop Health, and we talk a lot about healthcare planning in retirement. When it comes to people who retire prior to 65, health insurance premiums can be very, very expensive. Oh, yeah. Oftentimes $2,000 a month, give or take 100 or two here, for someone retiring at age 60 or 61 or 62. So Grace is with Scoop Health, and they are a medical cost sharing, I guess, would you say company or platform or collective?
Yeah, platform would be a great word.
So when we start doing retirement planning and we're looking at the costs for medical insurance and then the copays and deductibles and prescriptions, some people have more health expenses than others, of course, but everyone needs to be covered prior to Medicare in case something catastrophic happens. So it's one of the big expenses, hidden expenses for a lot of people who say, you know what, I've accumulated $1 million or $2 million and I'm tired of work. I just want to retire at age 61 or 62. And they come in for planning, and we go through the health costs. And some people say, you know what, I think I want to go back to work, or maybe I should work for another year or two. So we eliminate that item from the budget.
Yep.
So what I want to do today with Grace is kind of go through the basics, the history of medical cost sharing, how it's evolved over time. And we're going to get into some questions and ask Grace some tough questions here, because I've been talking to clients leading up to this interview, and they all basically have the same questions. If I get cancer, can I go to Memorial Hermann?
Right.
Am I going to have my choice of doctors? Or if something, the big one, of course, is if something happens to me, how do I know that the money will be there to help me pay for the expenses that I need for my health or my loved one's health? So we're going to get into those questions as well. So Grace, welcome to the show.
Thanks so much for having me.
Yeah, very, very glad to be here. And we're going to turn this actually into a YouTube video, but then we're going to do a separate YouTube shoot as well. So Grace has a YouTube channel. What's the name of your YouTube channel?
We're the Health Benefits Network.
The Health Benefits Network. So if you want to learn more about medical cost sharing after the Retirement Income Show here, feel free to go to the YouTube channel there and check it out at Health Benefits Network on YouTube. I'm sure there's a lot of great information there where people can learn more about medical cost sharing. So let's just start at the beginning. How old is medical cost sharing? Where did it actually begin? And then we'll have a conversation about how it's evolved.
Yeah. So, gosh, medical cost sharing, about 40 years ago, it started in the Christian-based health sharing communities. And over time, it's evolved, of course. If 40 years ago is kind of the benchmark that we see cited most often, nowadays there are hundreds of cost-sharing communities. Some are very small, some are very large. We work with several that are not faith-based anymore. That's one of the biggest evolutions that we've seen, is that eventually over time, some of us realize that not everybody shares the same faith-based beliefs, but a lot of us share the same ethical beliefs that, if we strive to live a healthy lifestyle, we should be rewarded for that. And as a community of like-minded people focused on our health, focused on our needs, and taking care of those unexpected health events in life, we've found that we can get a pool of people together to share in each other's medical bills, and it works out really pretty fantastic.
So how long have you been involved with the Health Benefits Network or Scoop Health in the medical cost sharing?
So I've been involved with Scoop Health for almost a decade now, and to medical cost sharing almost about 7 years is how long I've personally been a member. I've of course, like everybody, had needs come up in 7 years. From time to time, things pop up. I personally would never leave it. 7 years is quite a long time, and I don't see that changing.
So when we look at just health insurance in general, even though it's not called medical cost sharing, the concept is pretty similar with health insurance, right? The health insurance companies collect premiums. They have actuaries determine, okay, what type of investment return can we get on the funds that we have invested? What are the expected claims that we're going to have? And then, of course, they are the middleman. And this is one of the big problems in the health, in the medical world today, is you have this middleman, the health insurance company or the government with Medicare, negotiating prices and cutting kind of the individual consumer out of that process.
Entirely.
So first I want to just start with tell the listeners, how does medical cost sharing work in a very, very kind of basic fundamental level? If someone says, you know what, I don't want to pay $2,000 a month for health insurance, I want to explore how this works. Are there premiums? Are there deductibles? Just a very, very basic level. How does it work?
Yeah, highest level. Everyone pays in a set of money each month. We call it a contribution. You're contributing to the overall funds of this cost-sharing community, much like a premium. We call it a contribution. And then instead of a deductible, we have what's called an initial unshareable amount, or IUA. And essentially, that's the amount of money that an individual member, say me, you, whoever, is responsible for before they can look to the cost-sharing community to share in the rest of those bills. It's, kind of an individual burden, and you get to pick that level, of course. It could be as low as $500 per incident. It could be as high as $5,000. Everybody has a different comfort level. We've got a lot of 24-year-old guys who are healthy as a horse, and they're perfectly happy with $5,000. I went with something a little lower. I'm a little more risk averse. So everybody gets to pick that. And then when you do have a medical need come up, you're responsible for that initial unshareable amount. And then after that, you're able to look to the community and say, hey, I've met my burden that I agreed to. I've contributed money for however long I've been a member. Now it's my turn. Can I get the rest of these bills shared through help from the community? And that's at a high level how it works. It is very similar to health insurance, where they collect up money each month. They just pool it all together and pay for things as they come up. But it's the same thing. We've got people who are looking at the numbers on a monthly basis and saying, what do we think is going to come down the pipeline in terms of bills for the community? How much do we need to make sure we're bringing in each month in order to take care of those effectively? What do we need to have in reserve just in case there were a really bad, something or another that came along? But it's, by and large, it's the same concept of dollars coming in to share bills at some point down the road.
So you have an initial unshareable amount. You guys call it an IUA. And the consumer can choose what that initial unshareable amount is.
Exactly.
And that's essentially like a deductible, correct? It's not called a deductible, but it's ultimately what you have to pay first out of pocket before the community picks up the remaining costs for whatever health cost there is.
Correct.
What is the difference between someone who has a $500 IUA versus a $5,000 IUA? Are there caps on the rest of the costs that can be shared? Why wouldn't everyone just choose a $500 initial unshareable amount?
Yeah,
IUA.
Great question. So, as somebody who chooses a $500 unshared amount versus a $5,000 unshared amount, the $500 person's going to pay a little bit more. They're taking on a little bit less of that burden. So, $500 anybody can come up with if something really bad happened. $5,000 is a bit of a steeper climb to get there, so you're going to pay less each month. The other thing about the initial unshareable amount that I think is really interesting is it's tied to a health need. So that could be a broken leg, that could be a cancer diagnosis. And that initial unshareable amount, by and large, it's tied to that need. So it doesn't reset each year like a deductible would, where if you're in the hospital bed on December 31st, January 1 rolls around and you're still there, you pay your deductible again. This is tied. So, I've had a surgery before. The whole process through recovery and everything lasted a good 8 months. Had that rolled into the new year, that's a new deductible. And with cost sharing, it wasn't.
That doesn't happen. So the IUA is essentially the deductible, and the lower deductible would mean a higher monthly premium. Is that
correct?
Okay.
Yes.
And so what are the monthly premiums? So can we get into that? Are they called premiums? And can we get into how they work a little bit?
So we call them contributions. We make them once a month, just like you would an insurance premium. And, with those, there's no caps. There's no annual limits on how much you can share or anything like that. But we make our contributions once a month. Generally speaking, we see them being somewhere 30 to 50% less expensive than traditional health insurance. Obviously, if we got to compare apples and oranges there a little bit, but if we try to line up the numbers so that deductibles look somewhat similar to the IUAs and what have you, 30 to 50% is not surprising at all.
Okay. So someone who has a larger unshareable amount would have a smaller monthly contribution.
Exactly.
Okay. And then is the unshareable amount, is that similar to a maximum out-of-pocket cost? So let's say I have a $5,000 initial unshareable amount, and then I get into a car accident and my medical bills are $200,000. Is that $5,000 plus my monthly contribution that I make, is that the maximum out-of-pocket cost that I would pay, or is it possible I would have to incur some of that $200,000?
So in terms of, say, the rest of that large medical need, we have a set of guidelines, just like health insurance has an explanation of what your coverage looks like. And so, there are limits on things. For example, physical therapy, I know, is one. You've got a certain number of visits per medical need. It's a very fair number. Health insurance does the same exact thing. I personally went through that. It was more than enough for me. And so, there's certain things like that. But by and large, if you've got a large medical need, your initial unshareable amount, generally speaking, is going to be what you're responsible for. There could be some small things here or there, but I would say those are pretty off the wall. We don't see those happening too often. And then with the initial unshareable amount, you're essentially locked in at 3 of those a year. So if you had 3 large medical incidents, you're going to pay your initial unshareable amount on those 3. And then say you had a 4th, something really crazy happened, another car accident or whatever it might be. After number 4, if you've got another big one, you're not going to pay that initial unshareable amount again. You've paid those first 3, and the community is going to say, gosh, you're having a really tough year. You're done. We'll stop you there.
So how many people are I know there's so many different networks out here, so many different, collectives or co-ops that provide these services here. With Scoop Health and the Health Benefits Network, how many individual contributors are inside the plan? Do you know that number?
Oh, gosh. I would say industry-wide, the statistics are a little hard to pin down because it's always changing and it's always growing. But industry-wide, the numbers I've heard are we're into the millions. We're into the 2+ million range. It's it's a kind of a quietly growing movement. We don't have big lobbyists out there. We're not splashing out for ads on TV because we're spending our money on members' medical needs. So we're kind of a quietly growing little community. But it's steady as people they do get these bills for $2,000-$3,000 a month. I was talking to a family yesterday, $3,000 a month for a couple of 2 and 3 kids. That's not affordable.
No.
That's more than a mortgage.
Yeah.
And people can't do that.
Yeah. So when we look at millions of people contributing on a monthly basis into the medical cost sharing community, and a set of guidelines are established for how much will be paid out or how many physical therapy appointments and visits, kind of similar to health insurance there. Have you ever had a client where they had paid in their monthly contribution, they hit their unshareable amount, and then they had a medical need that their costs exceeded what the medical community would cover, and they got stuck with the bill for $20,000 or $50,000 or more? Have you ever seen anything like that happen?
I personally never have. Quite the contrary. I've received stories from members who, had a basal cell carcinoma removed, and the cost sharing community helped them find a price that was lower than their initial insurable amount even. So this particular individual had a $5,000 insurable amount. He was perfectly capable of paying for that. But the cost sharing community said, hey, we found a really fantastic high quality center right near you actually, and the cost was $2,000 versus, his insured amount was $5,000. So I mean, it's, saved him a good $3,000 on that. But yeah, I mean, generally speaking, the experiences that we're hearing are that people are taken care of, and they're coming away from these situations feeling empowered, feeling like a consumer again, and actually knowing what's going on with their healthcare, being engaged, and they're getting their stuff taken care of.
Last question for this segment, and we're going to continue this conversation. I want to get into in the next segment how the medical cost sharing community negotiates directly with doctors and hospitals. And one of the big benefits from what I've learned so far has been the ability to bring costs down for the consumer, and that through direct negotiation. And that's how the medical cost sharing community really leverages the contributions that they have monthly, plus the investment pool, the collective of contributions, to really get the most bang for the buck for members in the community. So when you look at somebody who is going into retirement, because the question is, who is this right for and who is this not right for? But when we look at someone coming into retirement and they're looking at $1,800 a month, $2,200 a month, $2,300 a month just for medical insurance premiums if they go the conventional route, is that person a good candidate for possibly medical cost sharing?
I would say so. I think the biggest driver of who's a great candidate, obviously someone is looking to save money. That's a no-brainer. If I can cut that in half, that's a great day. But I think one of the biggest issues there is pre-existing conditions. If you went out and tried to purchase a medical plan in June because something came up, your pre-existing conditions are not going to be covered. And it's a similar concept with cost sharing. Instead of just saying absolutely not, we phase them in over time. And so the first year, if somebody's got something pre-existing, there's not going to be any sharing for that. Now, I would say probably at least 50% of the people who do join have something pre-existing. I did. Most of us do. It all depends on, is it well managed? Are we able to tackle that with a simple prescription and maybe some lifestyle changes? Is it under great management with the doctor already? Or is it something that's going to get worse or become surgical or be something that is going to require a lot of costly expense? If it's well managed, they're probably a great candidate.
And that's a good thing, it sounds like, because you don't want people coming into the pool who are just going to be a tremendous cost without, contributing into
exactly.
their share, at least up to a certain point before they need, hundreds of thousands or millions of dollars worth of care. Okay, we're going to bring it back in the next segment. If someone has questions, they want to reach out to you directly, how do they do that, Grace?
They can visit our website, scoophealth.com. And we've got lots of information on there, YouTube videos like I know you do as well, phone numbers on there. And so, yeah, if folks want to reach out, that's the best way to get in touch with us and start to learn a little bit more. Okay, we're with Grace Gosnell of Scoop Health. This is the Retirement Income Show. 1-800-822-6434 if you want to reach out, have a conversation about how healthcare planning fits into your retirement plan. Give us a call, check out the website, and of course, visit the YouTube channel at Oak Harvest Financial Group on YouTube.